Barry, thus far in 2025, we've had a huge number of active ETF launches, a lot of them options-based. You launched the Shelton Equity Premium Income ETF. This is the SEPI. How is this different from all the other options-based ETFs out there?
Yeah, how it's different is that we write individual calls on individual names. So you see a lot of these ETFs are basically passive, where they're either buying the index and selling index calls or have a basket of stocks and selling index calls. We're actually buying individual stocks while selling individual calls. We bring close to 30 years of experience doing this. And this product was inspired by our mutual fund, EQTIX, which is rated 5 stars on Morningstar. So we're really excited about bringing this to the table.
And why is this the right market for that ETF?
Yeah, I mean, in today's market, we have high valuations, interest rates might be a little elevated, volatility comes and goes. What this does is it takes advantage of those factors. And what we're doing is generating additional cash returns by monetizing the volatility of the underlying positions. And also, a lot has to do with demographics. We have the baby boomers in retirement, maybe approaching retirement, and they're looking for maybe a risk mitigation strategy for the equities or some distributions. And that's what this brings to the table.
And where does it fit into a client's overall portfolio? There's 60-40. So if this one's generating income, does it go on the fixed income side or the equity side? Where does it go?
Yeah, historically, this used to be a satellite, right? You had your core 60-40 and then the satellite out there. So now this is basically being brought into, with all the growth that it's had recently, into the core portion of the portfolio. So your typical 60-40 portfolio, now we're seeing 50, 30, 20, and 20% going to this type of strategy. What it does, it has a different return pattern than equities and has a different return pattern for fixed income. So it's that nice in between.
Can you talk a bit more about how it's different from all the other covered call products out there? Usually you sell covered calls against an index and you just keep generating that cash. Yours is different. Just dig a little bit deeper into how it's different from all the other ones out there.
Yeah, I think what we're seeing now is with all the index option selling, you're seeing a dampening of the volatility for the indices. Now, the individual stocks, as we've seen, still have that vol. So we take advantage of that by selling the individual vol on the underlying equities. So we believe we're being active on both sides, where we're buying stocks that we believe are the best stocks to sell covered calls on, and then selling those individual calls. And we're taking factors like the volatility of the underlying equity, earnings, dividend that's being paid, and also the time and the strike price where we're selling it. So we're really active on the option side.
And then finally, yes, we've seen volatility dampened. The VIX has really hung out well below 20 for most of the year, except around Liberation Day. But if you are using these options around individual stocks, aren't you raising the risk a little bit? Because if you have a lot of volatility, it's going to be an inherently more risky stock.
No, I don't think so. So what we do is we look at names that have a defensive quality. So when you're selling covered calls, you got to remember your upside capped at a certain level and you have a lot of downside risk. So you have to manage that downside risk. So to use an analogy, if the speed limit's 65, I'm driving 50 miles an hour trying to avoid potholes. And so by selling individual calls on these names, we're able to sell further out of the money, get some upside while getting the similar amount of cash flow as a indice selling strategy.
All right. Well, thanks for coming on and talking about it.
Thank you very much. Appreciate it.